So let's look at the capital gains on assets acquired before 31st March 1998. So we said the capital gains tax was effective 1st April 1998. So what happens to the assets that were disposed of or assets that existed before that date? So we have transitional provisions under section 166. So no capital gains tax was imposed on assets that were disposed of before 1st April 1998. So if a business asset was sold before this date, no CGT applies on it. Then for assets that were existing but not disposed of yet, so if they were bought before 1st April 1998 and then later disposed of, then the capital gains tax applied. But then for that case, those assets had to be adjusted for inflation. For assets that existed before 1st April 1998, the gains or losses on disposal are taxed, and the cost base is supposed to be adjusted for inflation using the indexation to account for inflation. So the formula that we use for assets that existed before 1st April 1998 and later disposed of after that date, the cost base is adjusted for inflation using this formula: CB times CPID out of CPIA. So where CB is the cost or the expense incurred before 31st March 1998. So CB is like the original cost or the cost base that was incurred to buy the asset before 31st March 1998. Then CPID is the consumer price index as of 31st March 1998, and CPIA is the consumer price index for the month before the cost or the expense was incurred. So we have an alternative valuation for the assets that were acquired before 31st March 1998. So the alternative valuation, instead of using the other one of adjusting the cost base to inflation, if a taxpayer can prove the market value of the asset as of 31st March 1998, then they may use the market value instead of indexing the original cost base, or instead of adjusting the original cost base to inflation. So if they can prove the market value of the asset as of 31st March 1988, then that value is considered instead of adjusting the cost base to inflation. So another case for tax holiday adjustments. So if a taxpayer received a tax holiday under a certificate of incentives, the cost base of the asset for capital gains tax is the market value on the day the tax holiday expires. So in this case, we also have to adjust the cost base to inflation. So if an asset was acquired during a tax holiday, the cost base is its market value on the day the tax holiday expires. For example, if a factory was built in 2010 under a 10-year tax holiday, so it will have a cost base set at its market value, not the costs that were incurred to build the factory, but they will consider the market value when that tax holiday of 10 years expires. So the market value will be determined in 2020 when that tax holiday has expired. So they will not consider the original construction cost, but they will consider the market value when the tax holiday expires. I hope you've understood. We shall be having an example on capital gains tax calculations here in the next video. Thanks for watching. Do not forget to subscribe, like, comment, share with your friends. Let's catch up in my next video.